Good morning. Hope you and your loved ones are safe. Welcome to the Q4FY21 earnings conference call of CAMS. Representing the management today, we have with us Mr. Anuj Kumar, Full-Time Director and CEO, Mr. Somasundaram M, CFO, and Mr. Ramachandran SR, CFO Designate. I would now like to hand over the call to Anuj for his opening comments.
Thank you, Nischint, and good morning, everyone. Good morning to all the participants and the organizers. I'm pleased to be amongst all of you today, sharing our 4Q results, and also taking this opportunity to take you into, in a more broader way, what happened during the entire year. I'm sure you've all seen the results. You've seen the press release, and therefore, broadly, you are aware of where the numbers are. 4Q especially represented what I would call a solid trend, both in capital markets and in the mutual fund market during the year. Starting from 1Q, when we have seen sharp erosion in assets, sharp fall in sales activity across the board in the mutual fund market, and significant impairment to just basic activities like advising investors and physical meetings, etc. 4Q turned out to be quite a contrast to all of that, as the backdrop of the pandemic had eased up in many parts of the country. And now, of course, it has changed in the last 2 months. But I'm talking especially of the period Jan, Feb, March. We've seen a sharp run-up in the markets, that is largely equity indices. We saw improvement in participation in mutual funds, defined by several metrics, and I will get into the metrics of what participation metrics actually mean. We saw some valuation gains. We saw restoration of sales activities, new product launches, new NFOs, a return to positive accretion in several segments of money coming in, and an uptick in the SIP book, and an uptick in new investors coming into the market. So 4Q was in significant contrast to 1Q. And as we kind of take you through both 4Q and the full year, I guess you will begin to appreciate all of this. I will start by giving you some of the business highlights, especially pertaining to 4Q. One of the key metrics that we track is our transaction volume. Transaction volume is a summation of what the investors are doing. And therefore, whenever you see growth or significant growth, I think it's just a positive metric, given the fact that the investors are more engaged and are trying to do something with us. And in 4Q, we recorded the highest ever transaction volume, so a historic high of 17.2 million investor and distributor initiated transactions. So that's about 1.72 crore. This does not include SIP triggers, and included when that gets included, the number is different, and again a very large number. But I'm just restricting this to be exclusive of SIP triggers. You're aware that investor onboarding is a very key activity for the industry, and the easier you make it for the investor to get onboarded, the faster is the momentum of broadening the new investor base for the industry. Aadhaar-based eKYC, which had been in operation since about 2016, had been wound down, given specific instructions by the regulators and by the Supreme Court. But this was re-allowed or reinstituted sometime in 2020. So we launched OTP-based Aadhaar eKYC to facilitate digital onboarding of MF investors. And this, we are confident, will give a new fillip to the investor onboarding activity across the industry in the quarters and years to come. Our focus on distributors continued to deepen. We had launched our Edge 360 distributor transaction portal sometime in August, September of 2019, and it has picked up very well and has several thousand, multiple thousand distributors using it. We then broadened this out by launching the mobile app sometime in the March time frame. And what this does is that earlier it was easy for the distributor to be sitting at a desk and transacting. So today, if they're sitting in the car and the driver is driving, or if they're in a public place, it's easy to do transactions through the app. This was This was an expected broadening out of the offering, and we broadened it out by putting the S360 mobile app in the market in March of this year. Consistent with the philosophy of offering unique and very, very enriched digital facilities to investors, we continue to broaden out the reach of MyCAMS. MyCAMS has now crossed 4 million registered user milestone, and which is a fairly large milestone. That's 40 lakh people who've registered, who come once in a while, and some of them do come every day to monitor their portfolios and transact. So it's a unique facility, and again, the broadening out, the growth in numbers has been very, very encouraging. Our account aggregator business, which was licensed in March of 2020, and where we have kind of set up the entire backbone, and we started engaging with the marketplace to sign up with both financial information users and providers. You know, there are two parts of the business. A number of financial information users, potential users who are looking for investor information for various purposes, either for underwriting or loan approval or credit checks or portfolio management and wealth management, and all those areas are beginning to show interest. So we added about 15 entities for the CAMS FinServ account aggregator business who are potentially going to engage with us and on the information user side. We also then, as you may have read through our press releases, were offered the certificate of registration for CRA activity. This is with the National Pension Services, with NPS. There are two incumbent CRAs. We will be the third one. But pension being the space that it is, this is an exciting space. It will take multiple years to build this business out, but that's a good beginning. CAMS Pay payment platform continued to broaden services and are now integrated with a larger number of banks for direct credit services. In our investor satisfaction survey, and some of you may have seen it on our portal and in MyCAMS, this is a survey we conduct every year in the months of February and March to gauge the mood and gauge specific feedback from investors in terms of how they like our service offerings and what is it that they specifically do not like. Are there any improvement areas? It continued to do better and better in two respects. This was the third year we did the survey, and we got very close to just about 20,000 unique investors coming and giving their opinion, which is a very large, encouraging number. This started with about 10, 11,000 2 years back, grew to mid-teens, and then has grown to just under 20,000 this year. Satisfaction scores, which is satisfied or very satisfied, scaled past 95%. So it was an accretion. It was always a good score. It was slightly under 95%, so 94 and some change. Crept past the 95% number, and that continues to give us, strong vindication of the satisfaction levels of investors. But also gives us a very valuable feedback in terms of where we can do better, which we continue to deploy in service design, service delivery, and platform design. With the set of MIIs, and you know that the regulation is now kind of encouraging fintechs to engage with all parts of the capital market stack and launch innovative products, services, and service delivery formats. So not just new products, but you can also launch a new delivery format and welcome to come there and do these things. The Innovation Sandbox of Fintechs is a joint initiative of the MIIs and the two QRTAs. And we played a significant role in this development. And obviously now we are beginning to popularize this through events with the various chapters of TAI and the various other chapters of local startups and entrepreneurs that happen across the country. So we continue to do that. And then we continue to invest in leadership. We continue to broaden out our talent pipeline. We inducted 2 C-level officers in new positions. We brought in Indiva Krishna as a Chief Process Officer, and then we brought in Neeraj Lal as a Chief Risk Officer. These are all inductions over the last 4 months between January to April. And both of them come with large and very deep, very well demonstrated skill and capability sets in the financial services industry, mostly in banking, but also in insurance. So both have worked with large banks and insurance companies. And as we build our business and as we broaden out our service capability, we are very confident that we want to continue investing in leadership and bring over best in breed talent in the company. Just in terms of some numbers, for those of you who have seen the PowerPoint, it'll be easier to relate to these numbers, but this is all public information. I'm sure all of you, most of you are tracking these numbers. I will quickly give you an asset summary of what the assets look like. So like you know, last year, it was a great year for debt funds. Debt as a category, if you just saw assets month on month, quarter on quarter, or year on year, you would see a significant investor interest. So debt as a product category and an asset category grew quite well in the year. Equity, while SIP flows were consistent, lump equity wasn't really showing positive accretion for a long time, but starting March, there were net positive inflows into the equity assets, which is very encouraging. So think of it as the backbone being regular SIP inflows. These are people who have committed themselves for a long period and they don't change their minds every month. So they continue to bring in money. And then the lump equity investors also, when taken together with the SIP investors, the net inflows turned positive starting in March. In terms of overall assets, how did we behave? And I'll tell you this in two parts. One is just industry AUM. Despite the backdrop of a tough year at 32.1 trillion, and these are all industry numbers first, the assets grew 18.9% when we take Q4 over Q4 of 20. So when you take a year-on-year growth for the fourth quarter, assets grew almost 19%, 18.9%, which at the beginning of the year we had not imagined we would ever achieve, but that number came true. And when you see sequential quarters, again, these are industry numbers, assets grew 8.1%, 4Q over 3Q. Within this, equity assets for the industry grew 21% over 4Q of 2020. Again, strong, sustained growth, and then grew 10.8% over 3Q of 21. And again, I would say any quarter-on-quarter sequential quarter growth of double digits is very impressive. So those are industry numbers. If you see CAMS numbers, pretty much in line with this, our total assets are at 22.3 trillion or 22.3 lakh crore for 4Q of the year. Grew 19.2%, so grew slightly better than industry sequential years, which means over 4Q of 2020 grew 19.2%. Over 3Q of 2021 grew 7.3%, and within that, equity assets grew 18.5% over 4Q of 2020 and grew 12% sequential quarters 4Q over 3Q of 2021. So overall, while assets have seen a sharp fall off in 1Q, has seen some restoration in 2Q, but till about October end, we were still counting whether we were coming back to par. Starting October and then driving into November, December, and then driving further into Jan, Feb, March. I think the overall trend of assets and trend of participation grew very well, both for the industry and for CAMS. Our market share based on quarterly AUM is 69.5%. And in summary, when you're thinking of this market, think of it that overall AUM growth was largely led by debt throughout the year and equity in the last about 4 to 5 months. In terms of operational metrics, where did we see the operational metrics go? And like I said, each one of these is kind of a pre-indicator of what business is looking like because they're all foundational blocks in the business. Our total transaction volumes, earlier I'd given you everything exclusive of SIP triggers, but our total transaction volumes for the quarter were almost 86 million, so 8.59 crore. This was up 5% quarter on quarter and 2% year on year for 4Q. Our SIP book, and I told you that SIP sales, which is net participation in SIP, both gross SIPs being registered and the net ones we retain because some of the people do not renew and some do exit, is now over a 2.15 crore number, so 21.5 million is the overall SIP book. Grew 7% year on year and about 5% quarter on quarter. And just given the backdrop of the year and the fact that falling markets can create panic, I think these are strong numbers and good vindication of the fact that investor maturity is significantly superior now. And most of the times, investors bide their time and wait for the trend to turn rather than kind of flee in panic from the market. SIP transactions riding on all of this were 61.5 million, so about 6.15 crore. Again, grew about 4% year on year, 5% quarter on quarter. So all of these metrics, transaction metrics for 4Q, were uniformly positive, all growing single digits. But I would say when you grow single digit quarter on quarter, and then you grow single digit also year on year, but you're comparing yourself with a very normal 4Q of last year, because you will remember that last year Jan Feb were normal months. March was a troubled month, maybe starting the middle of the month. You're comparing everything to a very normal quarter last year. I think even single-digit growth is pretty good. Investor folios, and these are investor folios with balances. The folios without balance comprise another large chunk, but the ones with balance stand at about over 40 million, 3% up year on year, 1% up quarter on quarter. And unique investors, despite the rally in the markets, ended up in 4Q at 16.6 million, 5% year on year up and 2% quarter on quarter. So I think across these major metrics, overall transaction volumes, size of the SIP book, overall SIP transactions, investor folios and unique investors, I think across all those 5 metrics, we saw single digit year on year and quarter on quarter growth. And I think that's just a healthy foundational, I would say, a precursor of returning to normalcy, and including that, some of the signs of having returned to normalcy. When I look at the overall 12-month period, and in the 12-month period, like we said, the first 7 months, every time you compare 21 with 20, we have to think of the first 7 months having been significantly impaired, and then some restoration which began to happen maybe in the November-December timeframe. The numbers will be a lot more muted. So industry AUM at 28.5 trillion or 28.5 lakh crore was up 8.6%. This is a 12-month story. Against that, CAMS, if you take the annual comparison, this is for the full year, our assets grew 10.1%. So industry overall assets grew 8.6% year on year. This is for the full year, not the quarter. CAMS assets grew 10%. On equity, industry assets year on year grew 4% for the year. This is average for the year. CAMS equity assets grew 1.3%. So more muted for the year, more I would say accentuated for the fourth quarter. And on an annual basis, the market share is at 70.1%, so slightly better than what you see as the market share for 4Q. If I give you again 12-month operational metrics, the same 5 numbers that I've given you. This is for the full year, 12 months, so not 4Q numbers, but complete year numbers. Overall transaction volume was at about 323 million, down 1.5%. But when you see down 1.5%, again, remember the first 7 onerous months, all offices were shut. All sales activity was almost frozen apart from digital. And these numbers have grown in significantly in 4Q. Overall SIP book of 21.5 million, up 6.8% year on year. Overall SIP transactions at 237 million, almost flat. We're showing down 0.2%, but that's a very small number. So you can think of it as a flat number year on year. 40.4 million, the same number that I gave you for 4Q of live investor folios, and 16.6 million of unique investors. So I know I've given you a lot of numbers. For those who did not have the advantage of having the numbers in front of you, some of this may have been just too many numbers crunched in too short a time. But again, the fact that I want to underscore is that starting 4Q and maybe a little earlier, starting December, we saw the advanced metrics of investor engagement, investor participation, transactions coming in, unique investors, new unique investors coming into the marketplace. And then as we kind of traversed that part, we saw net inflows into equity becoming positive, debt having been on a strong clip for the overall year. Strong, if you take 4Q over 4Q last year, growth in metrics across the board. And if that were to be the sign of health in the industry, our belief is that that could become the baseline. And you know, and I know that April and May have again been very tough months, and we have probably been faced with the same onerous phase that we went through in April, May of last year. But from a foundational perspective, 4Q kind of restores our collective faith that the market and market participants' activity, as and when it comes back to normal, will drive all the foundational metrics, will drive our operating metrics, and will then conducive to define and drive our financial metrics. So I'll pause here and hand over to Ramcharan and Somu to take it forward from here and give you the financial numbers.
Thank you, Anuj. I will just take you through the broad financial numbers for Q4 as well as for the year. So in terms of revenue highlights, Q4, the revenue was at 199.8 crores, just shy of 200 crores, which was a 14.3% increase year on year. The comparable quarter revenue last year was 174.7 crores, and it was 7.4% up quarter on quarter. This is the overall revenue compared to 185.95 crores the last quarter. The revenue generally consists of a few components. One is the MF revenue and the non-MF revenue. And within the MF revenue, there is the asset-based revenue, which is calculated based on the assets under management handled by CAMS, and the non-asset-based revenue, which is the predominantly the transaction processing revenue and the out-of-pocket expenses, reimbursements, and call center revenues. So that's how the revenue is split into. In terms of asset-based revenue, this was up 18.5% year on year. The assets grew year on year 19% overall. And Anuj was mentioning this was a quarter in which we had both equity and debt growing year on year. Of course, debt was growing at a higher clip, and equity also came back to its growth pace in the last quarter. The quarter-on-quarter growth in asset-based revenue was 7.4%. In the non-asset-based revenue, we had a growth of 20.9% year on year and 2.2% quarter on quarter. As I mentioned, the non-asset-based revenue is driven by transaction revenue as well as out-of-pocket reimbursements, reimbursables, and some amount of call center revenue and NFO revenue. So this was the trend in the non-asset-based revenue. The non-MF revenue, which in this current quarter was actually down 16% year on year. This is a continuing trend as we saw in the earlier part of the year too. This is basically transaction-driven revenue for our payment business and our insurance outsourcing business. We also wound down as a conscious decision taken by the company last year, we also wound down the banking outsourcing business that we had. So this constituted a major part of the 16% down year on year. But quarter on quarter, aided by some uptick in outsourcing revenue, especially in the insurance sector and some extent the payment sector, we kind of had a 16.4% growth. So this is the broad composition of the revenue for Q4. In terms of the AUM growth and asset mix, the equity component, is remained same at 35% on year. This is again, this is manifesting itself because of the comeback in the equity AUM as a function of the entire AUM in the last quarter. And Year-on-year, compared to the last quarter, it is up 1%. Overall AUM growth, as mentioned by Anuj, year-on-year was up 19%, and the quarter-on-quarter number was 7%. In terms of our profit and EBITDA margins for the Q4, the PBT, the operating EBITDA was at 41.8%, almost same as the last quarter and the last year same quarter. The PBT was up 20% almost year-on-year. The comparable number last year was 67.4 crores up to 80.9 crores in the current quarter. And sequentially, it was up 7%, that is 80.9 crores as opposed to 75.5 crores in the Q3 of 21. In terms of PAT, again, it is up almost 40%. The comparison with last year Q4 was 40%. It's mainly because there is a tax rate differential also between PBT and PAT in the current year. We migrated to the new tax rates of effective rates of 25.2%. So the PAT is at 60.1 crores as opposed to 43.1 crores the corresponding quarter last year, and sequentially it is up 6.6%, which was 56.4 crores in the Q3 of FY21. Our return on net worth is at 46.6%, which is almost same as the last quarter, but compared to last year, it's increased from 31%. This was also a function of the dividends that have been declared in the course of the year. Let me quickly move on to the 12-month picture. In terms of the revenue from operations, the 12-month revenue was 705 crores. This is up less than 1% when compared to the FY20 revenue, but again, this is on the back of 2 quarters where we had challenges and not just Q1 and Q2. Because of the external environment. So if you actually look at the quarter-on-quarter numbers, the first 2 quarters, the revenue actually was less than around 27 crores. So even making that shortfall, we are kind of up almost 1% for the entire year to 705 crores as opposed to 699 crores in the last year. In terms of assets, again, as I said, the revenue is split into MF asset-based fee, non-asset-based fee, and the non-MF fee. So in terms of asset-based fee, we are up 8.4% year-on-year. And in terms of non-asset-based fee, we are down 12.6%. Again, this is a function of the drop in the transaction revenue because of the lesser activity that we saw in the first 2 quarters of the year. In terms of non-MF fee, again, as I was mentioning, this is a trend that we've seen the entire year. There is a drop in transaction-based revenue from the payments as well as from the insurance outsourcing sector. So we are seeing a drop of 24.7% in the non-MF fee year-on-year. Overall, if you see the mix, the MF share of operating revenue, which was around 87% in the earlier year, has now come up to 90% in the current year. On the profits and EBITDA summary for the 12 months, our profits PBT is up 11% from 246 crores to 274 crores. And our PAT is also up 19.4% from 172 crores to 205 crores. So very healthy growth in profits in PBT as well as PAT compared to FY20. And in operating EBITDA, the entire year we had an operating EBITDA of 38.7%. Again, the operating EBITDA is calculated on a non-AS 116 basis, which is leases capitalization is disregarding actual rent paid is taken. And the return on net worth for the entire year was close to 40% as opposed to 31% in the last year. So this in summary was the numbers, financials quarter as well as for the 12 months. And with this, I will probably hand it back to the moderator for him to take it forward.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravin Kurwa from ICICI Securities. Please go ahead.
Hello, this is Ravin Kurwa from ICICI Securities. Am I audible enough?
Yes.
Yeah. So, congratulations to the management for a good set of numbers. My question is around how many number of branches are operational now? Since these branches are of key strength, so in this COVID times due to frequent lockdowns in various states, how has this number panned out? And my second question is regarding the yields. How has the yields behave in Q4 and FY21 for equity and non-equity AUMs?
Okay. So let me take that. During the COVID phase last year, there were situations which had shut down almost each one of our offices, and that was because of the countrywide lockdown and the fact that almost all states had adopted it uniformly. This year, there are situations panning out in different manners. One is that states which have adopted a complete lockdown in a very serious manner, and Madhya Pradesh is, for example, one of those states where this started happening early. We would shut down our offices. There were stray incidents where the city or the state has not enforced full lockdown, but we may have staff across the board, just everyone, most of the people are in, and therefore we are forced to shut. And then there are containment zone issues and all of those things. However, if you take the aggregate picture, we have not exceeded more than 1/4 of our offices being shut at any one time. So think of it as a base of about 270 offices. At the maximum, we've had about 60 of them shut, and I'm talking of April and May right now. So the impairment has been smaller, and that is because there is no concept of a national lockdown. This is happening in waves. That's part one. On part two, on the yields, I'll give you a broad picture and I'll see if Ramasoma want to add anything. So overall, it's been an onerous year. And within that, like I said, the first 7 to 8 months were very tough, both from an operating perspective. There were large deployments of COVID remediation monies and expenses that we had to do. And this included everything, including enabling thousands of employees to work from home. Wherever there was firm lockdown, either in Bombay or in Tamil Nadu, in Chennai, we would put up large masses of our people in hotels. We had to undergo mass amount of testing, provide additional transport, and there were various cost heads. And all of those we incurred, which obviously were to our account. And there is significant appreciation amongst our clients that we are making that extra effort in this area. So broadly, the way you should think about yields is, one way to think about it is that yields held, and yields held because of 2 or 3 things. One, between the debt and the liquid box, if you take them together, which is non-equity, the fraction of debt improved almost every month and every quarter during the 12-month period, including in the last quarter. So yields of the debt plus liquidity box, the debt plus liquid box obviously went up. Equity improved its share of the total assets almost quarter by quarter, and you would have seen that it improved in 4Q over 3Q. So that added to the improvement. And the fact that overall, in terms of any new, rate conversations or negotiations, they were muted. If I put those 3 reasons together, that explains what's happened to the yield. But I'll see if Ram has anything to add to this.
Anuj, I think the major points were covered. The mix as well as customer mix. This covers the points.
Okay. And sir, what will be our concentration mix right now of top 5 AUMs contributing to the total AUM which we manage?
Ram, you want to take that?
Yeah, sure, Anuj. Can get back to the exact percentage, but the concentration remains same as it was in the last quarter. Most of the revenue, as the industry is also similarly, this is concentrated over the top 15 players, and revenue is also similarly concentrated for us over the top 10, 15 players. The exact number I can actually get back to you on.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Shelja from Concept Investwell. Please go ahead.
Thank you for taking my question. My first question is, like we see increase in capex. So how much are we aiming to add in operating assets and by when?
So let me just repeat your question. So is your question on our capex plan?
Right.
Okay. So just to give you a context, in the last year, given the circumstances that we had in the first couple of quarters, we actually went slow on the additional capex investments. But in the later part of the year, this was accelerated. We started investing into the technology, into the information security. So in the end of the year, we actually need to look at the last two quarters. The capex was kind of backloaded. So on a given year, this year we kind of did around 25 crores of capex. In the next year, I think the investments will accelerate on the technology platforms as well as on the information security requirements. As you know, regulatory as well as the current situation demands that we have the cutting edge technology. So we expect that the capex for the next year should be close to 40 crores.
These assets be ready and added in operating assets?
Yes.
I'm asking by when? In which year will these assets under? Right. My question is, is there a percentage that we keep on investing, a percentage that we keep on doing in capex, percentage of operating assets?
Yeah. See, just to answer your question, ours is actually a capex-like model, right? So it's not as if it's a capex intensive business that we run. So on a year-on-year basis, we would assume that the capex investment in a normal year will be around 25 crores, and these are all investments made in technology, which is your software licenses, information technology tools that we need to procure, and as well as the other cutting edge technology software that we procure. The major expense that goes into the platform, if you recollect, is the software development, which is actually OPEX in our books, which is the software programmers who actually work on code. They are actually employees of our 100% subsidiary Sterling, and hence these expenses are actually in the P&L as salaries and wages.
Okay, so I just wanted to get an average percentage that we always need to invest in, a percentage of assets that we always need to add on.
Yeah, and on a given year, given the current year, you take, for example, we have a 700 crores of turnover. We would invest around 25 to 30 crores on capex, and a little higher in an intensive year. So that should be the range we are doing.
Thank you. We would request the current participant to please come back in the question queue. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah, hi. Anuj Kumar at the beginning mentioned two senior talent is being inducted, Chief Risk Officer and Chief Process Officer. So while that is good news, but I'm surprised that this kind of positions didn't exist before, because in a very heavy process-oriented business like yours, that would have been an obvious position to always have, I would have thought.
Well, that's correct. So think of the Chief Process Officer as a backfill. This position existed we had an incumbent. It was created about 4 years back. We had an incumbent who left, and then this was a vacant position for about a year. The chief risk officer position is an upgraded position. So obviously there was a risk officer, but the chief risk officer is an upgraded position with significant capability in non-capital markets financial services industry, because we wanted to be sure that we are bringing on board the benefits and the advantages of people who worked in banking and insurance beyond the capital markets, just to be learning from them and imbibing the practices. That's how Neeraj Lal has come in. So this position used to be called the risk officer. The risk officer continues, and then we've upgraded and created a layer of a chief risk officer.
Sure. Thank you.
Thank you. The next question is from the line of Prayesh Jain from Yes Securities. Please go ahead.
Yeah, thank you, sir. Congratulations for a great set of numbers. I had a couple of questions. Firstly, where are we on the Franklin Templeton integration, and possibly some thoughts on how would it impact the profitability in H1 and for the full year of FY22? And secondly, now that we are into the, we have started tying up for the account aggregator business with various parties now. What is the revenue potential of this business, say in this year or possibly even 3 years down the road? And lastly, on the dividend payout, could you give us the absolute dividend number for declared for the last year, and what are the payout policy for futures? Yeah, that would be my two questions.
Sure. So on Franklin Templeton, we had got a verbal okay from Franklin in March of last year, and then we have signed a contract in August. Between August to now, we've been transitioning the work, and think of it this way, that we are close to being done. We're about 4 to 5 weeks away from bringing over the work and bringing over the people. So the transition has almost progressed in all its formats, and there are then those baseline processes of submitting and sharing integrity of execution and integrity of identical execution as Franklin was doing to their committees and to their auditors, etc. That is in progress. So all of that should get done in the next 4 to 5 weeks. And therefore, we're expecting this date has got deferred a little, about 8 weeks, just given the backdrop of the pandemic, work from home and those kind of complications. But we're expecting by end of June, this should be in. Now, we typically don't give client by client financials and numbers, but I would encourage you to just, this is all public information. You can see their asset size, our asset size, and if you add A and B, you will get the number. We're expecting the share to increment by close to a couple of percentage points, but all of that depends upon what is the value of the assets that come in at the time that they come in. But we are fairly advanced.
Yeah, just on that part, my question was more with relevance with regards to the expenses that we would be incurring to get them on board in H1. So whether that business will be profitable as from day one, or how the progress of profitability will move for that part of business.
So if I can just take that question. So I think we had guided even in the last earnings call. Two parts to it. One is the transition cost, which has already been incurred, is a part of the P&L. We are also doing a rebadging exercise for the FT employees. So what we had indicated is that it will take some time for the transition to be fully done and for a steady state to be reached, and the dictated state of the assets in FT also. So we expect in the course of the year they should turn EBITDA positive.
Okay. Yeah, my other two questions.
And if I may just answer your question on dividend also, Our stated dividend policy is to endeavor to distribute 65% of our PAT as dividend for the year, which we endeavor to do even this year, and we have kind of declared 65%. The dividend for the current year, if you see, could be a little on the higher side, but that's because of the special pre-IPO dividend that was given in the month of August. But for that, our dividend policy has always been consistently to give 65% of our PAT as dividend. In some years, it's a little more than that, but the endeavor is to give 65% of our PAT.
Okay. And my question on the new businesses, potential revenue.
Yeah. So on the account aggregator side, just think of it this way, that there are two parts of the business. There is vital interlinkage to information providers, let's say banks. There is a vital linkage to information seekers or users, which is the FIUs. And we are seeing now building up interest in the market on the user side, which means that that's pretty obvious that people would like to see what is the franchise somebody else has built. So that momentum we are beginning to see in the market. Information givers or providers is a more muted progress. It is progressing, but it is slightly muted compared to the enthusiasm that the users are presenting. So we signed up a set of users. We are testing a set of providers, and hopefully should be signed up with them soon, because there is a full test of both integrity, security, and the kind of linkage that you have to maintain with the providers. So all of that is happening. We've thought of the rate card and how the pricing will work. But I guess that any expectation of revenue, so our expectation is that revenue should happen in this year. But will it start happening from 2Q? A little early to say. We will continue sharing with you guys, because that depends on how many providers and users are seriously kind of architectured and integrated into the system for all of this to begin. So we are expecting that we should see revenue lines within this year, and we will continue sharing progress with you guys.
All right. Thank you.
Thank you. The next question is from the line of Siddharth Gupta from AS Stock Broking. Please go ahead.
First of all, congratulations to the management for a great set of numbers. I have a few questions. The first one is our share of operating revenue from mutual funds is roughly 90%. Given that we are venturing into other areas such as payment aggregation, etc., what is the management project over the next couple of years? Our operating revenue share would be? Would it roughly go down to an 80-20 split or further? Second, my question was that given that is there any plan for the management to increase the fee charged from mutual funds based on their AUM, like in terms of the percentage that they wish to increase? And thirdly, what are our projections for the payment aggregation business, which I believe is a brilliant endeavor that the management is making, and my hearty congratulations to them. But what's the management's view on the competition that already exists in the industry, and how are we placed to tackle it?
Sure. So let me take that. The numbers that you would have heard pre-IPO at the time of the roadshows was this was last year, that non-MF revenue aggregated to about 13%. Of the total, we voluntarily wound down the banking and NBFC outsourcing business, and that caused some impairment. So this number is at 10. We certainly want to improve that. We certainly want to build that number, and you can see that we have the right irons in the fire and the right efforts are being made. We are cognizant that running 5 key initiatives at one time for any management team can be very distracting. And we are also cognizant that if we change only one, that may or may not be successful, and therefore that would account for a bad strategy. So I think we have the right mix, and we are trying to scale these businesses. Will this get to 80-20 soon? So do we want to get to 80-20? The answer is yes. Do I have a time frame right now In terms of specific roadmap on how this will get and will it take 3 years, 4 years, or 5 years, we're not making any specific commitment on that. But the answer to your question is yes, we would certainly like to get to 80/20. On the payment aggregation business, while payments is a very growing space, and I'm sure all of us have read reports and have read reviews of how much investment is chasing entities and how exciting it is. Do remember that it's a crowded area. That it's a crowded area, and increasingly we are finding that it is becoming a price-sensitive area, which means that beyond a point, once you have the platform and you have a set of merchants, banks, and customers integrated, differentiation is small. Incumbents have some advantages, and we are not very large incumbents. Incumbents are other people. So incumbents have some advantages, but taking share away from an incumbent is also not impossible. So therefore, we also expect that while the market will continue to grow, some element of price sensitivity in the buyer will continue happening. And that's not just theoretical. We are seeing all of that happen. But it remains a very exciting space. We want to continue remaining invested. The regulator has given guidelines to move this business to a subsidiary. We are taking all the right actions to get that done. But more than that, we are engaging with the market, broadening out the product portfolio, bringing more banks on the platform, just to make sure that we're doing the right thing. So that's really where we are on the payment side. Was there another part of your question that I did not answer?
I'll probably take the pricing part of it. I think his question was more on customer pricing. So, as you know, this is actually a bilateral arrangement with the different MF customers that we have, the pricing is. And there is already a telescopic pricing structure built in, which gives a share to the customers as and when the AUM grows. In terms of specific customer contracts, while these are actually bilateral discussions that will happen as and when it is due, we expect the year to be a normal year in terms of pricing. I know, as Anu just mentioned, last year was we had incurred a lot of expenses on the COVID-related stuff, on work from home, on BCP, etc. So, it helped us to hold the heel. So we expect that the current year will be a normal year, just like, when there is a discussion for pricing, we will have that discussion, but we don't expect anything extraordinary in the current year.
Yeah, I'll just add, there was a question on, he was asking whether there could be an increase in price. Just to give the industry context, as you know, the overall pie available to the ecosystem is determined by the SEBI regulations, which specifies what can be the charge to a scheme. And as you would be aware, it is a telescopic pricing. As the asset size keeps growing, the charge to the scheme keeps coming down. And therefore, within that framework, all the players in the ecosystem, which is mutual fund, the distributors and the RTAs, as the asset grows, the unit realization will come down. That's this one. And therefore, in a growing asset scenario, increase in price is not a normal phenomena. It doesn't happen. It has happened in the past in very unusual circumstances, like a continuous stagnation for a couple of years in the asset growth, which is not a usual phenomena in the Indian mutual fund industry. Most of the time, assets keep growing. So the price increase is a little bit unusual. It could happen for a given client because of very specific reasons, but it's not a normal phenomenon.
Okay, sir. Thank you so much for your answers. They were very helpful.
Thank you. The next question is from the line of Ashil Shah, an individual investor. Please go ahead.
Hello, am I audible?
Yes, we can hear you.
Yeah. Hi, sir. Congratulations on a good set of numbers. So I had a question regarding the multiple new AMCs that are going to come up, either from the distributor side, like a Funds India or a Grow or an ET Money, or from the PMS side, like let's say Alchemy and Helios and all of those guys have applied. Is there any strategy to aggressively pursue those and add them to your client list?
Yeah, certainly. So what we continue doing is we engage with entities across the board, and new AMCs can come in several ways. Like you said, some of the PMS operators will try to morph themselves into fund houses. And then some of the new age people who started as RIAs, distributors, digital RIAs will also sense that they could be better off in the FS business. One or two of them may just wait for the license to come, and the others may potentially think of acquiring someone. And you've seen all of that in the market. So the answer is yes. We continue engaging with everyone that we see that is interested in this business. Our track record of having one new AMC logos over the last 7 or 8 years has been very strong, pretty much. Most of the strong names, especially promoted by banks, corporate houses, that have come to us. So that's a normal part of the operation, which continues to focus on these relationships.
Okay, but so is there anything specific that you will be doing? Because from what I understand, I believe CAMS is a little bit more expensive than the competitor, and the product differentiation from does not seem like too much. Is it like a price? Will it be a pricing game, or is there something extra you'll be offering that will attract these guys to you?
See, conceptually, as a philosophy, we sell value. We don't sell price anywhere. That's the philosophy with which we approach markets. I would just give you what the market thinks. This is not what I think. That there is significant differentiation. Differentiation capability exists for RTAs, and that differentiation actually exists because it's a very thick stack of services, and it's a very broad platform. So within that, for offering A and offering B to be identical, I mean, it's like you may think that two email platforms are identical because both are sending emails, right? What else do you do? But when you go into the depth, you will see that there is just a lot of differentiation, slice by slice, scope by scope. The entities, the participants behave very differently. The market is pretty cognizant of that. They're cognizant of what we deliver, what we stand for, the value that we bring to the table, whether it is day-to-day delivery, compliance, digital capabilities, sales enablement, aggregation, quality of analytics, and quality of platforms. So the market is aware of this because mostly people who are applying have been in these capital markets for several years, if not several decades. So to give you a short answer, we sell value. We expect to be paid for the value. That belief has been vindicated over the last 2.5 decades, and we believe that belief will continue to be vindicated.
Understood, sir. Thank you. And so one other question was on the GoCorp, CAMS Pay, and Edge 360. Is there any strategy to monetize it, or would it just be add-on services to your clients having them being your clients essentially?
So initially, when we had started, we were okay to just put it on the plate for these offerings to be consumed. Over a period of time, they have become substantive in size. GoCorp, I'm sure you've seen that metric which we've been publishing, saying over 20% of our share of the liquid and overnight transactions go through GoCorp. So that's a significant share a single platform has. And that took us about 5 or 6 years of hard work. So our aspiration is obviously that we should monetize. And again, it is obviously that our customers should see value in that part of the delivery and pay for it. So we continue to engage in those dialogues. Success takes time, so it is taking time there too. But to answer your question in brief, yes, it is our aspiration for that part to be monetized.
Okay, sir. Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, Dhanyawad, sir, for the opportunity. Sir, firstly, if we take the employee cost, what should be the percentage we should look forward as a percentage of revenues, the employee cost, sir?
So let me take that question. So we should, on a historical trend, I can tell you, again, this is dependent on the investments that we continue to make in talent. And this is also a function of the staffing that we will have to do from transaction perspective. As and when there is a growth in transaction, there will be requirement of additional staffing, but there will always be a lag. There won't be a one-to-one correlation on a quarter-to-quarter basis. But historically, our employee cost has the range of 35% plus or minus a few percentage points.
And sir, under these employee benefit only, the managerial, the KMPs are also the remuneration are being debited.
Yeah, that's right.
Oh, right, sir. And sir, what constitutes the major part of the operating expenses?
So operating expenses consists of two major parts. One is the OPE, the out-of-pocket expenses that we incur. This is compensated by a similar revenue line item for us. And there is this component of software expenses that we incur, right? Which is basically the various licenses that we buy. Those things actually constitute the operating expenses, main part of the operating expenses. Then there is some amount of claims that gets into it, even when we have a mispayment on the claim.
So those are clubbed under other income that you are getting the same.
No, the operating expenses has got, yeah, that's right. OPE, that is out-of-pocket expenses, is what we pay, but we get reimbursed. So that's compensated by a revenue line item.
That is in the other income, clubbed under other income.
That is a part of the total revenue, which is not other income. It's a billing to the customer.
Okay. Sir, and sir, the entire data processing and all, everything is cloud-based. How is the data storage, the safety, and the servers are, and the backup systems are being created? What steps have we taken? How much have we invested into it? Because the entire, everything is in the digital format. So, God forbid, if there is any kind of cyber attack, then the restoration work, and how well are we prepared for that, and how much is on the cloud system? What is the strategy there, sir?
Sure. So think of it this way: for mutual funds, it's an entirely on-prem model, and by that I mean that all the applications, all the data, and all the computing power is in our data centers, 3 of them, primary, backup in city, and then the FAR DR. So 3 data centers, mostly on-prem, every part of the stack, which is everything related to the internet, applications, data, and computing. For newer offerings, which is payments, account aggregator, I believe for CRA, it's too new for me to what architecture we will go with, but we are deeply evaluating the cloud. Payments is almost completely on cloud, and account aggregator will also be on cloud. BCP, security, and every other part of the protocol, that execution does not change too much because the principles remain the same. So think of it as our password policy, our storage policy, our restoration policy will remain the same on whether we are working on-prem or whether we are working in the cloud. In the cloud, of course, there are restrictions, and there's still an evolving thought on how much data you can place on the cloud, which is why mutual fund continues to remain on-prem. But wherever there's regulatory acceptance, and wherever the market practices are consistent, we are moving things to the cloud, especially in the newer business lines.
Thank you. The next question is from the line of Dipen Sheth from Crystal Investment Advisors. Please go ahead.
Hi, and thanks for the opportunity. I have a question when I look at what you've achieved over the last 3 years, from FY18 to 21. And I want to take a longer perspective because I understand that the year that has just ended has seen all kinds of disruptions, and you've done good, and you faced trouble, but you've done some good things. You've taken up new initiatives. That's great. But when I look at 3 years, over a period of 3 years, FY18 to 21, I can see that consolidated revenues have risen just about 10%. Okay. And PBT has risen about some 16-17%, and that too is driven by a cutback in OPEX and other expenses, which is creditable. But for a business which has 30-35% kind of margins and doesn't consume any capital, I don't think you have even 200 crores of hard assets on your books right now. And I don't see you adding substantially to this number even as you invest in new initiatives, right? So for a business that doesn't have hard assets, which means it doesn't require reinvestment to compound its growth. Until top line comes, what's the excitement of owning a 30% margin business which is not growing? I mean, I'm looking at it as a greedy shareholder, of course. The worry I have is that this is a fantastic business, but it's kind of a utility. And as you create extra volumes and you grow along with the mutual fund industry, you don't post non-linear growth in profits for me. Is that a fair criticism, or am I missing something? You did allude to telescopic pricing as well. I understand that. But even within that opportunity, within that pressure of having telescopic pricing, I would have expected a company working at high margins and close to zero consumption of capital to be able to figure out avenues to grow top line rather than just cut back on expenses and deliver a growth in bottom line.
Okay. Let me take it. If you look at the way mutual fund industry grows, I'm going now slightly backwards. Typically, the way the industry grows is that it goes through a period of sort of a consolidation, and then there is a very fast-paced growth. And then again, it gets into some sort of a consolidation for a couple of years. That has been the trend which you have seen over a long period, 15 years kind of a scenario. Now, the last 3 years has come on the back of the previous 5 years. I'm talking about starting from March 2014 to April 14, March 19. If you look at that period, our revenues were growing at 19% CAGR. So that was the kind of growth we were having, and that the bottom line was also slightly a tad above. The operating profits were growing at a 20% kind of level. Now, what it reflects? It reflects essentially in a way industry. We are a play on the mutual fund industry. Our performance in a very large way reflects the industry, this one, and the assets that we manage. Of course, not exactly the industry, because during the same period, our share has grown very substantially, almost 4-5%, which means we would have grown faster than the industry. So the fact is, the last 3 years has come back on a period of 5 years, which saw a hectic pace of growth. If we were to give some numbers to you, just one second, let me give you some of the AUM numbers. If you were to look at the FY14, the assets that we were servicing was 6,57,000 crores. In that, equity was 1.75 lakh crores. Then we went all the way up to 6.23 lakh crores in equity, and overall assets grew by 15.8 lakhs. That's the kind of growth we had. And then it was followed by a sort of consolidation, especially on the equity assets. While the overall assets may not show that kind of a slowdown, if you look at just the equity assets, it grew by almost just about 10% kind of level over the 3-year period, FY18 to FY21, if you look at. So your observation on 3 years is correct. But if you go back slightly backwards, you will find that this company has been growing at a very, very healthy high double digit. So high double digit is wrong, this one. High teens kind of growth. That's the way we would look at it. The other one which I would like to mention is that our efforts in growing non-mutual fund revenue has not been too successful. So I'll not deny the fact we ventured into
Thank you, Nischint. Thank you, everybody.
Thank you. Thank you, everyone.
Thank you. On behalf of Kotak Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.